Hey, it's John from stopsaving.com and welcome to the first video in this new section of our course on technical analysis. In this section, we've got 6 videos on indicators, which you can use in TradingView. Now, there are hundreds of different indicators that people use in their strategies, and I've probably tried at least half of them myself. And what ends up happening is that you get analysis paralysis, which does nothing to help you become a better trader or investor. So, I've picked a handful of simple indicators to use for this course, and these will do the job better than most indicators, especially if you know how to use them properly. So in this video, we're going to start off with one of the simplest indicators of them all, and that's moving averages. Not only are moving averages simple to use, but they can be extremely effective when used the right way. That's because moving averages can show you the strength of a trend. So with all that said, let's jump in. So here's what you'll learn in this video. Number 1, what simple moving averages or SMAs are and how they are calculated. 2, the main SMAs to be aware of and how to use them. 3, what exponential moving averages or EMAs are and how they differ from SMAs. 4, how to trade moving average crosses. And finally, number 5, when moving averages work in trading and when they don't. So let's begin by answering the first simple question, which is, what is a simple moving average? Well, it's basically a line that shows the general trend of an investment by cutting out the noise. But unlike the trend lines we covered in an earlier video, moving averages and their lines will twist and turn as the price action evolves. That's because they connect the average closing prices of the last X number of trading periods. For example, the 50-day simple moving average will update each day to reflect the average closing price over the past 50 days. That means it will change tomorrow, but only slightly. So even though the price might move a lot in one day, since we're talking about an average of 50 days, the SMA won't move that much. In other words, it smooths out the volatility to get a general direction of the trend. Of course, you can have moving averages based on hours, days, weeks, or even months if you like. So when it comes to moving averages, there are 2 important concepts to understand. The first is the slope of the moving average. A steeper slope means the trend is getting stronger. And when it comes to steepening trends, there is no better example than this 50-week moving average on the Bitcoin price. On the flip side, a steepening slope can also be a sign of caution. As you can see with Bitcoin here, the slope of the SMA practically went vertical on 2 occasions before Bitcoin topped out. And we all know what happened after. Now, the next important thing to understand about moving averages is the location of the asset relative to the moving average. Put simply, it's better to buy when the price is closer to a moving average than if it is trading very high above it. That's because moving averages tend to act like a magnet for the price. Eventually, they always catch up to it. You'll also want to consider whether the price is above or below a moving average. In other words, ask yourself if the moving average is acting as price support or price resistance. Of course, there are many different moving averages to choose from, and in order to decide which moving averages to incorporate into your strategy, you first need to know what trading time frame you're trading on. And you'll want to use moving averages that match your trading time frame. For example, if you trade the 1-hour charts, you'll want to use 1-hour moving averages. And if you trade the weekly charts, you'll want to use weekly moving averages. A few videos back, we went over this table, which explains the different trading timeframes and the candles you could use for each of them. You can refer to this table as often as you like, and that's no different when choosing moving averages to suit your trading timeframe. Once you know your trading timeframe and style, you can then pick a range of moving averages within that timeframe. So let's use this 1-week chart of Bitcoin as an example. You can see 5 different moving averages here, ranging from the 10-week SMA in green to the 200-week SMA in white. Notice how the 200-week SMA is the slowest, meaning it's the least responsive to short-term price movement. The 10-week SMA is the fastest, or the most responsive to recent price movement. So as a general rule, shorter-term moving averages are more responsive to price changes than longer-term moving averages. And if you're using the weekly timeframes, the 10 and 20-week SMAs can be good options for helping you try and time the market. And depending on the asset, there are often good long-term opportunities for buying at or below the 200-week SMA. And here's the S&P 500 index, which on this 1-week chart has been trending higher for years. And that's where weekly SMAs can work well, when an investment is in a long-term uptrend. Again, big opportunities for the brave souls who bought the index when it was below the 200-week SMA in white. Now, we've covered weekly moving averages, but as I mentioned earlier, you can have moving averages on any time frame. And here are some SMAs for the Bitcoin 1-day chart. For daily time frames, you might trade a bit too often if you use the 10 or 20-day SMAs. So it's probably better to focus on the 50 SMAs and above, especially if you'd like to cut down on trading costs. Notice too how the moving averages got wider apart when Bitcoin was in a strong trend, but crisscrossed around when Bitcoin was ranging and consolidating in a sideways pattern. So as a general rule, moving averages tend to be a lot more useful when the price is in a strong trend, be that an uptrend or a downtrend, because when it's ranging sideways, you'll get chopped around a lot and potentially lose money if you rely on moving averages in your trading strategy. Moving averages are useful tools for trend traders and swing traders, but range traders, not so much. We've covered simple moving averages, but what about exponential moving averages, or EMAs? Well, EMAs are just like SMAs, except they put more weight on more recent price action. This makes them quicker to respond to price changes than SMAs. It doesn't really matter too much whether you use SMAs or EMAs, but personally I like to use a combination of the 8 EMA, the 21 EMA, and 50 SMA for my strategies. So when it comes to weekly EMAs, there are 3 that traders typically like to use, and we can see these here on the Bitcoin 1-week chart. First, there's the 8-week EMA in green. This can act as price support in very strong uptrends and as price resistance in very strong downtrends, like we see here on the Bitcoin 1-week chart. Then there's the 21-week EMA in yellow. The price usually starts to bounce off of this when the trend is still strong, but not quite as strong as it is with the 8 EMA. And finally, there's the 55-week EMA. This is a good one for longer-term investors to focus on. So here's the US dollar index on the 1-week chart. Again, notice how the 8-week EMA held as price support when the trend was at its strongest. You would have had many trades buying the index on the way up when it retested the 8-week EMA as support. Then there's the 21-week EMA. This would have given you fewer trades but kept you invested for most of the rally and only got you out when things really took a turn for the worse. but the 55-week EMA in this example wouldn't have worked out so well and would have only gotten you out here. So let's now look at moving average crosses, and we'll use this 1-week chart of the NASDAQ. A moving average cross is when a faster moving average crosses and closes over or under a slower moving average. In other words, when a shorter term moving average crosses a longer term one. Now, moving average cross strategies tend to work better on weekly rather than on daily timeframes. Take this strategy here, which is to buy the NASDAQ whenever the yellow 21-week exponential moving average crossed above the 50-week simple moving average. Now, I used ChatGPT to write the code to backtest this strategy in TradingView, and as a bonus video at the end of this course, I'll show you exactly how to test trading strategies yourself using a combination of ChatGPT and TradingView. So we're getting to the end of this video, and let's sum up what moving averages are good for. The first thing is that moving averages can keep you in a winning trade for longer. For example, if the price keeps bouncing off the 21-week EMA, you've probably got a good reason to keep holding on. With that said, moving averages are also good for indicating the next potential targets after a close above or below a moving average. For example, if Bitcoin closes below the 50-day SMA, the next downside target to look towards might be the 100-day SMA. Moving averages are also good for acting as potential price support or resistance. And finally, moving average crosses can be useful to signal changes in a trend, especially when looking at bigger time frames like the weekly chart. And here's what moving averages are not good for: trading in choppy sideways markets. So that's it for moving averages, and here are the key takeaways. Number 1, a simple moving average, or SMA, is a line connecting the average closing prices over the last X number of periods. Those periods can be hours, days, weeks, or even months. 2, an EMA is like an SMA, but it puts more weight on more recent price action and is more responsive to it. 3, moving averages are simple yet powerful tools to incorporate into your trading strategy, and that's because they can tell you about the strength of a trend. And 4, always use the right time frame and count for moving averages to match your strategy. And finally, number 5, moving averages and moving average crosses don't work well in sideways markets. We've now covered the main things you need to know about moving averages. In the next video, we'll look at the Relative Strength Index, or RSI. Adding this to your strategy is the next important piece of the indicator puzzle. So thanks for watching, and I'll see you in the next video.